All right, we are at that time. My name is Lauren Lemunyon. I am the new Executive Director of the Environmental Markets Association, and I am so honored to welcome you to our first official kickoff webinar of the 2021 series. We had a town hall last month, but we are getting into the content today, and we're excited to bring it to you. It's State of the Markets. We are bringing you some high-level content. We've got some fun in store for you, but before we get started, we have some housekeeping items. Yes, the fun stuff. All of your lines are muted. We are set up currently as a webinar. So if you have questions, use the chat feature. You can talk amongst yourselves. You can see who else is on. You can connect with one another. You can ask questions of our panelists. You can disagree with our panelists. In fact, we encourage that. We are recording this webinar, and a link to the recording will be sent out to you within 3 business days. And before we get started, we have another webinar coming up. That's right, one on deck. Next month on July 13th at 4 p.m., lifting the lid on the Maryland cap. So after you're done with this webinar, you can go ahead to enviromarkets.org, enviromarkets.org, just how you registered for this, and the registration is now open. And if you're a member, guess what? It's free. And if you're not a member, guess what? You can join. So I'm going to stop talking. I'm going to stop sharing my screen, and I'm going to turn it over to our moderator for the day, Jim Carruth.
Hi, thanks, Lauren. Appreciate that. And good afternoon. I'll just make a short intro and then we'll get right into it. Environmental markets today are hot and poised to massively expand in the coming months and years. And EMA welcomes you to our first ever State of the Markets Press Roundtable. This is a distinguished panel of journalists and analysts who will share their unique perspectives on our markets. Today, we have Mike Ball of Argus Air Daily, Elana Knopp of New Project Media, Dan McGraw with Carbon Pulse, and Jennifer McIsaac with S&P Global Platts. I'm your host, Jim Carruth, and I'm the Communications Director here at Incubex. For those of you who don't know us, we design, develop, and market environmental contracts that are then listed with our partner exchanges at Nodal Exchange and EEX in Europe. Today's conversation will touch on key market sectors and dive into policy moves at the state and federal levels. We'll also talk about drivers that will propel these markets going forward. What might the left coast and the right coast carbon markets look like in the coming years? How are rec markets shaping up? What are renewable fuels looking like? We'll finish it off with a short lightning round with one-word answers. And we're going to have some fun with all this and still provide some great perspectives on what's happening out there. So let's start with a quick roundup of the markets that you watch. And we'll start with Mike Ball from Argus and work our way through the panel. Mike?
All right, thanks, Jim. Thank you, Lauren, and thank you to EMA for inviting me to speak. Just want to quickly go over a couple of markets of note. Just go ahead and advance a couple of slides. I think we'll be good to go. It's a quick view of Argus there. Just to kind of give you kind of what's going on in a couple of markets we track and maybe some new market news to talk about. Just to talk a little bit about what's going on in the California low carbon fuel standard market right now. It's actually pretty interesting. Not surprisingly, a lot of it is tied to what's been going on with the COVID pandemic and recovery from it. We've seen a little bit of a decline in the market earlier this year as they were leading up to the compliance deadline. A lot of folks were kind of looking out for renewable diesel projects and so forth. But, I think really just 2 key points I think I could point out with this graph really here is if you notice that for the series of assessments we do right now, we look at the prompt market and also 4 forward quarters. It's a little bit backward dated because you've really got 2 things pulling at the market right now. And that is, like I mentioned before, the COVID-19 pandemic and the recovery. We've seen the price tick up a little bit in the last couple of weeks. In fact, yesterday we had the first decline really in the assessment in about 2 or 3 weeks. And that was because PG&E was holding a big auction, which helped to kind of bring people to the market. But what's happening is, the economy is set to reopen next week. And so I think there's a lot of anticipation of what that might mean for transportation fuel demand. I think if you've been following the market over the last year or so, with COVID, there was basically this huge drop in driving. I mean, essentially nobody, 30, 40% from certain months compared to 2019. And in the last few months, we've seen that rebound where it's basically just within just a few percent of the 2019 levels. And so what we're anticipating, or I think what the market is anticipating, is an increase in transportation fuel demand, which will mean more deficits that need to be covered under the program, which will mean more demand for credits. And so that's why the price has been going up a little bit. But at the same time, the market is a little bit backwardated because you've had just over the last year or so, just a lot of different announcements from refiners saying they were going to increase their production capacity for renewable diesel, which is already the leading credit generator in the program. And so people are anticipating more supply coming in. So you're seeing the prices a little bit lower further out. Next slide. And then I just thought also might be interesting to talk a little bit about the PJM rec market right now. It's been on kind of an interesting ride the last month or two, basically since the spring. And a lot of that is really around what's going on with policy in the area, particularly in Maryland. What we saw in the spring, March on through up through April was, as you see here, the price kind of going from about $11, $12 per megawatt hour up to 17, basically because there were some expectations, anticipation, if you will, that states like Maryland, Pennsylvania, and Ohio might take steps to increase or bring back previous renewable energy rec mandates, which could increase demand. Now, Maryland's the only state that has kind of followed through on that. Just a few days ago, a big set of RPS overhauls came into effect, and that included removing black liquor as a tier 1 resource, which could decrease substantially the demand available for compliance. I think it was in 2018, 2019, black liquor accounted for about 23, 24% of the recs that were used towards compliance. But at the same time, what happened is the legislation was getting ready to come into effect. And this is why you see a little bit why you see the price decline since April, is that a lot of folks who had contracts for black liquor recs, from what we've been told, were trying to secure those contracts for longer term because those would be grandfathered into the programs that may mute, sort of offset some of the potential decline in supply. And also just some folks we've talked to think there's a bit of a price correction, that maybe $17 was a little too high, is a little too far up for the market. Yeah. All right, and next slide. And just to go a little bit retro here, as some of you may be aware, there is a new NOx market coming online in just a couple of weeks. EPA is launching a new Group 3 seasonal program under its cross-state air pollution rule. This has been a pretty dormant market for a couple of years now because it's been oversupplied. You've got a lot of power plant retirements, coal not being used as much, natural gas and renewable energy being used in its place, so emissions are going down. But now EPA is coming up with this new program that's launching at the end of the month, the Group 3 seasonal NOx, which is going to cover power plants in 12 states with more stringent NOx caps. And what's interesting about that is, at least at the moment, it seems like emissions could be pretty close to the cap, unlike with the previous programs. But one thing to watch out for is, as I mentioned before, there is still a lot of coal capacity retiring. And just according to our own Argus database, from what I've been able to tell, we've got about 2,600 megawatts of coal-fired capacity retiring just this year that would be covered by the program. But because those power plants haven't been running a whole lot lately, that's only going to be about 1,700 tons of emissions basically avoided from the program. And we've recently started assessing this market. Right now we've got it about $27.50 per ton. Just by comparison, the Group 2 seasonal NOx program, which is the one that's in place right now, is $270 per ton, and the annual programs are like $2 or $3 per ton. So it's a big price difference. And now we're kind of looking at what the market looked like maybe 15 years ago, which is kind of surprising. Next slide. And just to, again, here is just to give you an idea of what states this new program is going to affect when it comes online at the end of the month. Basically, a lot of the Midwest, Steel Belt, Mid-Atlantic states plus Louisiana. In the next slide. And just to wrap up, I just want to give you again what I'm talking about with the emissions here. If you look on the left here with the dark blue bars, that's what the emissions from the power plants that are going to be covered by this program were at in 2019 and 2020. Compared to the 2021 budgets on forward, right now, the emissions last year were about, I think it was like 3,000 or 4,000 tons below. So, we're still waiting to see what's going to happen with this market. I think a lot of folks are kind of waiting on the sidelines until EPA gets it up and running. There's still several steps left to be taken before it does that. They still have to issue the allowances, convert the previous bank of allowances into the program. But once they do all that, I think it's pretty likely we'll start to see some more activity. All right, thanks.
Thanks, Mike. Appreciate that. As an aside, actually, Incuvex and Nodal just launched NOx Group 2 and 3 contracts, so we're happy that you mentioned it. Elana, why don't you take it from here?
Sure. Thank you, Lauren. Thank you, Jim. Thank you, EMA, for having me. I really, really appreciate it. Just waiting on the slides. Oh, great. Thank you. Yeah, so I'm senior reporter at New Project Media. We're based in Princeton. My territory is the Northeast region, and I also cover national news, national policy. Next slide, please. So something that's been really interesting to me has been my coverage of voluntary carbon markets. It's been really interesting to talk to folks in the corporate sector about what's driving these markets, and that's absolutely what's happening in the boardroom. Obviously, companies are moving forward. They're listening to what their investors want. They're listening to what their board members want, and even most importantly, what their customers want. And so they're adjusting their business models. They're committing to net zero or net negative emissions. And today, more than 1,000 companies have committed to achieve net zero by 2050, which is really impressive. And that's only going to grow more and more. Next slide, please. So, and I'm going to get more into this later. I'm not going to run through the whole thing, but there are several things that are obviously standing in the way of voluntary carbon markets. This is a lack of standardization. That's a really big problem. Carbon offset projects also, they offer a lot of different attributes like project type and geography, and that can influence their value. That's causing some confusion within these transactions in the market. That's something I'll get into a little bit later. Then there's the issue of legacy credits. That's a really huge issue right now in VCMs and how to deal with them. There's some disagreement on how to go about that. And I'll touch on this in a little later, but a report recently released talks about the fact that there are 700 million tons of old carbon credits. Many of them aren't considered viable anymore in terms of offsetting. So that's obviously a really huge problem. So that's what makes voluntary carbon markets so interesting right now, is because they're kind of trying to wade through these muddy waters and figure out how to do this. Next slide, please. So something that's I've been watching, it's been introduced, it's the Ocean-Based Climate Solutions Act. So it's a bill, and please enjoy my pretty ocean pictures over there. So this bill is obviously being touted as a major step in addressing ocean impacts of climate change. I feel like we don't hear a lot about that. And honestly, I haven't done a lot of coverage on that simply because this is a new bill and it's only been introduced. We're not beyond that yet, but I'm watching it. So it establishes a pathway to protect 30% of oceans by 2030, which when you think about it, that is a really vast thing to do. That's a lot of ocean. So, and it recognizes carbon storage potential and other co-benefits provided by blue carbon ecosystems. So we're talking about salt marshes, seagrasses, and these natural resources can capture and hold carbon, and they act as a carbon sink. And that's something that has not really been talked about that much until now. So I'm really hoping that this bill moves forward past introduction. Next slide, please. And what this would do is it would incorporate coastal wetlands into the carbon market. So it'd be buying and selling carbon offsets. And the approach would create financial incentives for restoration and conservation. And the bill would establish something called the Blue Carbon Program within NOAA. And so that would be working with federal and state agencies and tribes and NGOs. And that would develop basically a database of US blue carbon stocks and fluxes and things like that. So definitely something I would tell everybody to keep their eye on as it moves forward. Next slide, please. So yeah, enjoy my next gorgeous picture there of a farm, really into carbon farming too, simply because it's really just a really cool way to go about carbon offsets. This is something that's increasingly gaining attention as a viable way to sequester harmful CO2 emissions. And there's a lot you can actually do on carbon farms. I'm finding in my reporting, as I talk to these folks, land managers, actual farmers, they really want a piece of this. This is something that they've got their eye on. And there's just so many positives about it. According to the American Farm Bureau Federation, I actually spoke to them, voluntary and incentive-based tools like this, it could really spur farmers to adopt ways to mitigate GHG emissions on their farms. It could really get them to adopt some of these practices on their farms. And there's a lot of different ways that they can go about doing that. But they do say that there needs to be investment in agricultural research to develop new technologies to capture more carbon. It's really a very new sector right now. So there's not that much science out there to support it, but they're working on it. And so this is kind of a new sector that I'm definitely keeping my eye on. Next slide, please. So yeah, this is interesting too, that agriculture and forestry practices, they account for at least 24% of global carbon emissions. We often talk about emissions from buildings and cars and things like that, but we really don't talk too much about the agricultural sector. And so that's why it's so important to actually get into carbon farming and to invest in that research. And there I have it. Climate scientists estimate 200 billion tons of CO2 would need to be removed from the atmosphere to begin to reverse the effects of climate change. So, changing the way the agricultural sector grows its food seems to be a really good place to start, I would think. And finally, like I said, demand for these carbon removals is high, but the costs are really high to develop these projects right now. So that's something that they're going to have to work through. Like I said before, these scientific methodologies are still in development. So, as more farmers participate, the inventory of these high quality credits will increase, but obviously this will take time. So what's exciting to me about the sector is that it's up and coming. It's something that a lot of people want to take part in, but we're still going to we need to see a lot of research and development and innovation. And so obviously that's going to be interesting to watch. Thank you.
Thanks, Elana. I'm going to turn it over to Jennifer McIsaac from S&P Global Platts to take it from here. Jennifer?
Okay, yeah, thanks very much. I wanted to use my time to give a brief high-level overview of some of the themes and key drivers for compliance markets across the US that we're looking at Platts. And I don't know if Lauren can pull up my slides. Okay, great. Thanks, Lauren. Yeah, so the first slide, if you just want to advance it, looks at state clean energy goals. So of course, there's been a growing number of states that have clean energy goals and net zero goals. We used to just show the RPS map. I couldn't really find the RPS map, but that's okay because these things have been becoming more inclusive, moving beyond just what's considered renewables to expanding that definition to get to clean energy. So without a federal carbon price, without a federal RPS, it's really been up to the states to take the lead on this. And of course, there's varying levels of ambition. And you can see that there's more ambition on the coast where we have the compliance rec markets. Some things to note from national policy is that the Biden administration is saying they want 2035 carbon-free power. That's even more ambitious. It's an accelerated timeline versus California's goal for SB 100. Also, the Biden administration has been talking about maybe a clean electricity standard, which would look at the carbon life cycle emissions from electricity. The other thing we might want to keep an eye out for is a replacement for the Clean Power Plan. So that would be a regulatory program under Section 111D of the Clean Air Act. We've had Clean Power Plan, we had ACE. Maybe we'll get another iteration of that from this administration. Next slide. Moving over to RGGI, RGGI has been exciting. We had New Jersey back in, Virginia, and now we're looking ahead to maybe is Pennsylvania going to join. So the governor, of course, wants to join, maybe not necessarily with the support of the legislature. So that brings up a whole bunch of issues about joining without the legislative backing. Could they be blocked by the legislature? Could there be lawsuits? Could there be barriers to auctioning allowances if you don't have that underlying legislative authority? But nonetheless, looking forward to Pennsylvania possibly joining. You can see the size of Pennsylvania and their coal emissions compared to the entire 11-state RGGI region right now. They're extremely significant. So bringing Pennsylvania under that cap and trade would bring more coal under the cap and trade structure and encourage coal to gas switching in Pennsylvania. Next slide. I want to touch on something that's exciting for California. It's the scoping plan update, and it's going on right now. You know, there's webinars. I think one webinar is actually taking place as we speak. So they've launched this process. It's supposed to wrap up in 2022. And this is really comprehensive because it looks at the entire suite of California's policies to get them to their 2030 emissions target of a 40% reduction versus 1990 emissions, and then looking ahead to mid-century carbon neutrality. So here I have from this 2017, the last scoping plan, you can see the mixture of direct regulations. So those are complementary policies that drive emissions reductions outside of price signals. And then we have the price signals, LCFS, RPS, the cap and trade. So it's very important to follow this process because we want to see if there's any clues that are coming out as could there be future program amendments for the LCFS or the cap and trade. I mean, if you've been following the cap and trade discussions over time, and this dates back to the 2017 scoping plan, you know, there's stakeholders and people in the legislature that are saying that, you know, there might need to be some revisions to the cap and trade, maybe some supply revisions just to make sure that you meet that 2030 target close to 2030, and also just make sure that the cap and trade price signal reflects the actual climate ambition of California. Okay, so next slide. I just want to take you over, and Michael, of course, already brought this up, but this is Platt's infographic of the renewable diesel and SAF capacity announcements. So there's been a real explosion of this over, you know, the last year, even maybe a little bit more recent than that. So this could bring on a lot of capacity for these key drop-in fuels of renewable diesel to displace petroleum diesel and SAF to displace petroleum jet fuel. So then the question is, how is this going to affect the markets? And are we going to have new markets? Are we going to have new demand centers for this stuff? So you can see the shading. We have the LCFS operational market in California and Oregon and up in British Columbia. You know, Washington just got their LCFS, third time's the charm. They got that over the legislative hurdle. So those are demand centers for some of these fuels because, you know, you can't, it doesn't look like you can fit all of this renewable diesel and SAF into the high value California LCFS market. Also of note, in Canada, the Clean Fuel Standard is supposed to start up toward the end of next year. That's an economy-wide liquids program. Their diesel pool is about twice the size of California's diesel pool. So that would be another demand center to consider. Just want to flag over on the East Coast, they're looking at sort of a different type of transportation initiative. That's the Transportation and Climate Initiative, cap and trade, cap and invest type structure. And something to note here is that out of all of the states, you know, 12 or so states that were working on this over time, only 3 states plus DC in the end decided that they could actually proceed with launching the program. And I think even in recent days, there's been some questions over whether Connecticut is actually, you know, prepared to launch this program. So just this brings up some of the issues with these transportation sector programs and how they can be perceived to maybe cause pain at the pump and consumer issues, and, you know, how do you get them over some of those hurdles. But definitely LCFS and these transportation sector programs is an area for growth in environmental markets. And then my final slide, I just wanted to use this slide to touch on some of the issues with RINs and then also supporting all of those capacity additions that we saw on the last slide. So this shows Platts recently launched price assessments for SAF, sustainable aviation fuel, and renewable diesel. These are not traded prices. So these are cost-based assessments. So you can see that over time, SAF and renewable diesel prices on those orange lines have come up considerably. And that's reflecting the significant increase in the feedstock, because the feedstock cost makes up the overwhelming majority of the cost to produce these fuels. Then you can see the area chart here, the layered areas shows the incentives. So there are layered federal, and in the case we flag here, the California LCFS credits. These layered incentives help to bridge the gap between the higher cost of these low carbon replacement fuels and then their petroleum counterparts. So you can see the blender's tax credit there on the bottom. In the middle there, you can see we flagged the D4 RINs. And again, going back to that explosion in feedstocks, you can see how the RIN portion of this graph has expanded. And then also just note finally that California LCFS credit portion, and that attracts the lowest carbon fuels to California. And I think that Michael mentioned earlier that since 2018, renewable diesel has actually been the #1 credit generator in the California LCFS program. Okay, so thank you. I think I'm gonna leave it there and turn it over.
Thank you, Jennifer. And batting cleanup, we have Dan McGraw. Dan, why don't you give us kind of your quick overview, and then we'll dive a little deeper into each one of these topics. Go ahead, Dan.
Yeah, so I don't have slides because I don't believe in them. I'm really going to wrap, I think, a lot of what everybody else just said kind of together. Just from my perspective, I think there's 3 kind of areas that I think are very interesting. So in 2021, or kind of in the next few years, we're really seeing kind of a phase of review for some of these compliance programs. So if you look in California and RGGI, we're both going through scoping plan, we're going through program reviews. Both of those are likely going to result in some sort of revisions or changes to the program, probably in the 2024, 2025 time period, which really just, kind of extends out where we're going to go to 2030 and maybe, potentially past that 2030 target. So what are our long-term goals here? And then just kind of one of the things that I think we've seen both in compliance markets, but also in voluntary markets, is just like an increasing interest from corporates, commodity firms, financial firms that, in the past might have been hesitant to get into environmental markets for one reason or another. But now I think they're seeing this as one, a requirement, either from their shareholders or just something that they see a lot of value in. So California is a good example. We've seen, significant interest from financial firms, starting in 2018, 2019, kind of dipped a little bit during the COVID crisis, but we've seen that steadily rise kind of throughout 2021. And then on voluntary space, I think you're also seeing, a lot of corporates saying, it's our responsibility to do good here, and also provide that little service where, if a company wants to get to a net zero goal or a carbon neutrality goal, then, there needs to be somebody that helps them get to that goal. And there's an opportunity for financial firms that are maybe more well-versed in markets to, help them get to that target. And then the third thing that I just wanted to touch on is, and this kind of sounds a little back-ass, but during the Trump administration, you didn't see a whole lot of action on the federal front from environmental, regulations and whatnot. But what I think you did see is a lot of state level action. And I think what you're seeing now is a lot of the state level action that started in 2016 all the way through 2020 is now kind of rearing itself up in 2021. So we've already talked about Washington finally getting across the board on cap and trade. You're seeing North Carolina talking about some sort of cap and trade program, potentially looking at RGGI. Pennsylvania, I mean, there's across the board, there was a lot of bottom up environmental policy, where if you go back and you look at the Obama administration, there was a lot of top down. So it'll be interesting to see, as we've seen that bubbling up from the state level, whether or not you'll see the federal government allow that to continue, or if they take a little bit heavier hand. And that's really all I got.
That's great. Thanks, everybody, for your intros. Why don't we break it down a little bit further? And Dan, since you kind of ended on that note, maybe we'll jump into the carbon markets first. And obviously, we are seeing quite a bit of action at the policy level around the U.S. And you touched on California. RGGI has, a new entrant this year, and obviously Washington, kind of getting started here. So, in terms of policy changes and some of the market drivers, kind of what are you seeing there? Maybe Dan, I'll let you dive a little bit further into what's happening in California and maybe even WCI a little bit further. And then Elana, if you have some thoughts on what we're seeing, over in Reggie. But Dan, why don't you just kind of continue on? I really like that kind of the storyline you're presenting there.
Yeah, so I mean, I think Jennifer mentioned that California began the scoping plan process, which is not a sprint, it's very much a marathon. So nobody should expect any changes tomorrow. This is not a regulatory document in the sense that it is not going to implement any changes, but what California is trying to do is recalibrate everything. So every 5 years, they look at their environmental suite of policies and they recalibrate it where they think they need to, what they think they need to do to hit their long-term goals. So this year, one of the things that they're going to incorporate is, the carbon neutrality goal. You're also going to see some of the Newsom executive orders, primarily the phasing out of gasoline-powered new vehicle sales. So how do you kind of take those executive orders and actually put them into practice? Anything that comes out of the scoping plan is going to filter down into these individual programs. So if you look at something like cap and trade, California might determine, hey, yes, something needs to tighten up, or we need to make some revisions to cap and trade. The scoping plan itself doesn't make that change. They're going to have to go through a rulemaking. They're going to have to do the formal process, go through it, and make tweaks in a very transparent manner. So that's one thing to look out for. And it really depends on, when you look at the timelines there, you're talking about the scoping plan is probably going to be done at the end of 2022. So you're talking about, potentially you're not seeing changes to any climate program in the near term. If you're looking at cap and trade, it probably take, a year plus to go through the process of a rulemaking. And there's a few things that they haven't touched on yet that they still need to. So whenever the scoping plan does conclude, you're going to see them jump straight into some sort of rulemaking for cap and trade probably. On Reggie, they haven't started the program review yet. Some of that has been, they've got Pennsylvania sitting on the sidelines, and they're supposed to join in 2022. So they've more or less taken an approach that kind of slow walks the program review to allow them to fully enter the program, be a full functioning member, and then they can get really kicking in the scope or the program review process. That bit is a little bit, it's a little bit like herding cats, and then it's also not necessarily, it's a little bit quicker than cap and trade in the sense, or WCI, where you've got 11 states now, you have to reach an agreement. Last time it was a very long process, but hopefully it's a much quicker process this time around. So you could see some changes in there, hopefully by mid-century. And then I think one thing that I would bring up just on both of these programs is you're going through this process of, are our caps accurate? So California, I think they've gotten a lot of pushback, or they have gotten a lot of pushback from academics and groups, even politicians saying, hey, the 2030 goal is potentially, we risk missing the 2030 goal because of the cap and trade program. So I think you're going to see a lot of evaluation of that in the scoping plan, but also in the post rulemaking process. For Reggie, like I mentioned in my opening, there's been a lot of state level action. And a lot of that state level action is actually going to have to show up in this Reggie program review. So you think of somebody like New York that's put out a climate neutrality goal, that's functionally going to show up in this next program review. So I think you could see some pretty substantial changes to Reggie that maybe make it a little bit more sexy in the the environmental space.
Sounds good. Elana, how about that? Can you pick up on kind of what you're seeing in Reggie as well? Are we looking at some major changes to the program? Obviously, it kind of comes in kind of a bespoke kind of manner, but what are you seeing?
I think I think Dan laid that out really well. Obviously, I've been watching Pennsylvania, an outlier always in the Northeast. But I would like to touch, I think there, kind of want to mention carbon pricing for a minute. I think a lot has happened around carbon pricing that's worth mentioning. A lot of states and utilities, obviously, and markets are grappling with how to incorporate carbon pricing directly into their markets. And in April, FERC did issue a policy statement, which was much welcomed by a lot of folks in the sector. And they were talking about how we'll consider market rules proposed by RTOs. I will say also, I've been watching like ISOs like NISO, for instance. They've been advancing a plan for a while now to set a carbon price. PJM has also been looking at that, whether carbon pricing would work in its markets. But one thing I will say is that if any carbon pricing proposals are approved by FERC during Chairman Glick's tenure, I'd say those proposals would probably start in RTOs and ISOs that don't cover multiple jurisdictions. So it'd probably start in something like NISO, because obviously PJM covers multiple states. That would be harder to coordinate when you're attempting to set a price on carbon. So that should be interesting to see. And I would just say that any FERC action on carbon pricing would probably be part of a broader set of regulatory actions. I would think. Chair Glick, he still needs to work. We've got a Republican majority at FERC right now for at least a bit. So, but I think that the Biden administration's push on climate and decarbonization policies, I think that'll help things along. But like I said, if FERC does further develop carbon pricing, I would think it would be in the context of a broader set of actions.
Okay, sounds great. Thank you. Hey, we've got about a little over 20 minutes left and a couple of markets to get through. I would like to touch a little bit with you, Jennifer and Mike, on Virginia and Pennsylvania. Obviously, Virginia joining the RGGI this year, and then Pennsylvania. You did touch on it in your opening remarks, Jennifer. Pennsylvania joins this thing. We're talking about just by a visual, it looks like they're going to be about 2/3 of the overall emissions in the market. Kind of what's your take on that? I know there's still a lot of unknowns and a lot of hurdles left to get through here, but it looks like Governor Wolf wants to push this through.
I guess I can start. Yeah, I mean, absolutely. It's going to be interesting to see, I think, what happens with the legislature. I mean, just yesterday, the House Environment Committee there passed, again, a bill that they got through last year to try to basically stop Pennsylvania from joining RGGI, by requiring legislative approval for the regulations. Wolf was able to successfully veto that last year. He may not have the margin to do that this year. The bill had support from a fair number of Democrats last year. Republicans picked up a couple more seats in the legislature in the elections last year. That might be just enough, and we'll know in a few weeks, I imagine. They haven't had the votes just yet on it, but the Senate Environment Committee passed its version of the bill last month, and the House passed yesterday. So I think we're gonna find out soon.
Jennifer?
Yeah, I mean, I don't even have a great deal to add on that. Earlier, I did try to go through some of the main points and some of the main challenges trying to get this through. Virginia faced this too with a regulatory versus a legislative. You're more limited what you can do with regulatory authority, and you might be more vulnerable and not actually be able to execute on joining RGGI. So we have to watch this carefully. We've been trying to figure out if we should include Pennsylvania in our RGGI forecasts for years now, and it's just one of those things that we have to wait and watch, but it would certainly be good for Reggie if Pennsylvania could join.
Hey, Jim, I just wanted to add, I mean, one of the things when you look at Pennsylvania, or two things that you see when you look at Pennsylvania is it has a lot of similarities to where New Jersey was when you had a Democrat-led legislature and a GOP governor, and they basically canceled each other out. Here, you're seeing something very similar in that you have a Democrat governor who very much wants to join, and you have a legislature that absolutely doesn't. So Pennsylvania, to me, and I think a lot of people that follow it closely, expect it to be, you know, a legal decision. It's going to end up in the courts at some point. The connection there are two connections there that are kind of key and important here is whether or not they can succeed says something about New York's ability to be in Reggie, in the sense that New York never passed legislation to be in Reggie. And Pennsylvania is taking a very similar approach there and saying, you know, we have existing law that we can do this. And the other thing is that, you know, somebody like North Carolina is looking at a Reggie-like program. They're in a very similar situation, at least politically, and so it allows them to kind of get into the program that way. So, just from an emission standpoint, it's not rocket science. If you look at a lot of the modeling from ICF, it looks quite oversupplied by mid-century. You're seeing a lot of coal that's going to flow off the grid just in general, whether they join Reggie or not, kind of in that 2025 time period. So there's a lot of low-hanging fruit in Pennsylvania, and because they adopted the structure out of Reggie, it probably doesn't properly address that emission reduction potential there.
Yeah, that's great. Yeah, thanks for that, Dan. Hey, I'm gonna skip back into the voluntary carbon markets a little bit, and Elana, I'd like to get a little bit deeper in there. You know, we've been talking about voluntary carbon markets for a long time. They're nothing new in particular, but I did think that Mark Carney's voluntary carbon task force late last year and this year really kind of jump-started you know, a renewed focus on these markets, and started out okay, but now we're really seeing a lot more media scrutiny of the program and of voluntary markets themselves, and you know, the difficulty and the hurdles that are there. What's the potential here, and what's it going to take to reach it?
Yeah, that's a great question. So I'll start with the potential, and the potential is really great. You know, over the last couple of years, it's, you know, demand has really risen in the voluntary carbon market. As you know, the task force, it estimates that the VCMs need to grow by more than 15 times by 2030, which is absolutely massive. That's obviously to support, you know, 1.5 degrees Celsius pathway laid out in Paris. Potentially, this could be as much as a $240 billion annual market. That's the truth, depending on which industries really go for it. For instance, like if the airlines suddenly say that they're going to offset everything, that would be like humongo, right? So obviously, you know, this is driven by corporate commitments. They're very interested in carbon offsets. More than 1,000 companies have pledged to be carbon neutral by 2050, to align with Paris. And for a lot of these companies, they need to do that with carbon offsets. That's the way they can achieve it. Half the GDP right now, the US has declared explicit net zero targets by 2050, which is huge, and more every day. But the question is, like, what's the net in net zero? You know what I mean? What is a credible offset to an emission? And is that offset going to be here in the future, not just right now? Is it going to be useful? So right now, it's a market that it should be measured right now in like the billions of dollars per year, but it's not. Right now, I think it stands at about 300 million per year. And that's because there's a really wide range of quality of offsets, and there's a lack of standardization. Like I touched on before, it really, the the VCMs really need a major overhaul. If you're talking about almost 700 million tons of carbon credits available, and many of those 700 million tons are not even considered valid in terms of offsetting, that really puts those legitimate carbon reductions at risk. That's a real big problem that the task force is trying to grapple with right now. You know, as they move further into their development, and they've been putting out reports pretty regularly, they're realizing that they really need an overhaul of the market. One idea that they could do, they could try and solve this issue, and that would be for carbon market registries to clear out those low quality legacy projects. But obviously, the problem with that is the fact that these registries already have contractual obligations, right, with developers, and they've undergone, you know, the processes of registering and validating their projects. So that's going to be tough. But there is a research team that I've been speaking to that they are working closely with Mark Carney's task force, and they have a couple of potential routes to deal with these legacy credits. One would be kind of handing registries a central role in the market. So that would create standards for you know, defining and approving these projects, and then it would authorize the release of carbon credits once they would be verified by approved auditors. Another idea that they put forth is creating an independent regulatory body, and that would oversee the integrity of the market, and that would restrict the use of legacy credits, which is all important. And then they talk about a consumer-led approach. So that could also help, you know, limit the use of older legacy credits. And then you'd see groups of carbon offset buyers agreeing together to the highest standards of environmental integrity. So they've got a lot to work through, but I will say that they are actively working through it. I think that they will get there, but they've got to figure this out.
Understood. So thank you very much for that, Elana. Hey, I'm going to skip forward because I do want to talk about RECs. I do want to talk about renewable fuels, and our time is ticking away. And so I would like to just maybe, you know, flash back to you, Mike and Jennifer, and talk a little bit about, you know, yeah, we have more aggressive goals. I really like the map that you provided on the states and DC, you know, with the RPSs. So, you know, what impact are you seeing these, you know, more aggressive programs and goals in terms of wind and solar development? And then how is that translating into the markets in terms of bullishness, bearishness, you know, neutral? Mike, you already touched on PJM. Jennifer, why don't I give you first crack at it, and then Mike, maybe you can chime in if that's cool.
Yeah, so the RPS, like the compliance REC market pricing, is very, very dependent on policy. You know, you saw Mike's slide earlier, but you know, if you took like a little bit longer look, you can see that we've had prior boom and then bust and then kind of boom again, leveling with the lows in 2017-ish for PJM, and then 2018-ish for New England. And then what we've seen is that a number of states have come in and they've kind of shored up their RPS, and then that's resulted in the higher prices that we are observing now in both New England and PJM. So, you know, we had key legislation in New Jersey, and even before this most recent Maryland that kind of revised the older Maryland legislation, but that was important. Virginia coming on with a mandatory RPS. Massachusetts and Connecticut, you know, trying to keep in step with the development of the resources in those programs. And then we even saw Maine doing something recently too. So if you look at class 1 and tier 1 REC markets, the growth is in wind and solar. And that's not surprising, you know, that's sort of what's been incentivized by these programs. And then of course you have those targeted markets and those targeted incentives for solar in particular. You know, in Massachusetts and New Jersey, you know, those programs have transitioned a little bit away from the tradable credits, but they're still, those states are very much supporting solar. I just also wanted to touch on in New England with the higher prices recently, they've also been sourcing RECs from other states. So for example, one of the biggest growth observed in supply over 2020 for 2020 compliance was bringing more wind in from New York from those legacy units that kind of rolled off of the contract. If you look ahead, you know, states are being targeted in their procurements too. So just the big thing is the offshore wind. So states in New England and states in the mid-Atlantic too are really betting big on offshore wind. And then this is going to affect their RPSs too. So depending on how they want, you know, the rec markets to look, they would have to make sure that they keep on the RPS targets and make sure that they account for the offshore wind, which is dominating the build queues right now. And whether it's going to come on time, you know, the timing of it, and then just the magnitude of it is huge. So those are some of the things for the rec markets.
Yeah, that's great. Thank you, Jennifer. Mike, you want to pick up on that?
Yeah, I think just kind of to come back to the current market states for the moment. I mean, the Maryland, like I said, step back and say, like, there's kind of some interesting, almost conflicting signals in a way on kind of the solar side, which is nationally, the U.S. had a great year for solar last year, much better than people expected despite COVID. But what happened with the Maryland legislation, for example, that just came into effect, is they actually rolled back the targets for the next few years, just slightly, but still keeping their overall goals for the next 10, 15 years. Which is interesting, and that was actually something that developers asked for, because they said, hey, look, we're worried that COVID's going to slow down the development a little bit. But at the same time, that might not be as big of a hit as folks are expecting, because the regulators there are projecting an increase in load next year, which could mean an increase in rec demand. So might not be too big of a deal there. But just to kind of go off what Jennifer said was, yeah, there's definitely a lot of other programs are going to build demand. Rhode Island is just about to enact a 100% renewable energy standard. That's going to pull in demand from the New England. And yeah, a lot of these, I think offshore wind is going to be the thing to watch, even though it's not going to be a near-term effect on the market. I think the fact that the Biden administration a few weeks back went ahead and got things moving forward with the Vineyard Wind project was a big deal for New England, because up and down the East Coast, you've got so many states that are really going to rely on these offshore wind projects. And then today you had the North Carolina governor says he wants 8 gigawatts of wind by like 2040 or 2050. So it's moving down the coast, and we're going to have California is going to start looking offshore wind. So that's going to be where I think a lot of this is going to come into play.
Yeah, that's a great point from both of you guys on the offshore wind stuff. That is such an interesting dynamic that's going to play into these markets going forward. Really interesting storyline to watch there. Let's touch on renewable fuels so we can hopefully get to our lightning round and wrap up. Looking at RINs, obviously the EPA and with the RFS has undergone some major twists and turns over the last 2 years with small refinery exemptions and then challenges to those and so on. As you look at the RIN market, Jennifer, what are some of the key drivers that you're looking at there? And then I'd like to kind of switch back over to LCFS, but maybe we can just touch on the RIN market real quick.
Yeah, so I think that the main things to hit on there are the policy uncertainty, like you mentioned, and also the feedstock costs. So, today I think I checked, we have RIN sitting at $2, a little bit above, so that's more than double since the beginning of the year. Meanwhile, since the beginning of the year, corn prices are up over 40%. Soybean oil prices are up over around 70%. So that's like 8-year highs. The last time we saw that was in 2012 when the US was coming out of drought conditions. So that's probably, that's very significant driving that. Also, waiting on the policy side. The 2021 mandates were supposed to be set late last year, still waiting for those. So we have to follow that and see what's going on. And then also the small refinery exemptions. And there were arguments in the Supreme Court in late April to try to review a lower court decision that limited those small refinery exemptions. So of course that would directly affect RIN demand, and we're waiting to hear on that too. That's my quick answer.
There's still a lot of uncertainty in that market, isn't there? Switching over to LCFS, Dan, we're seeing, a lot more renewable fuel production being driven by that market. You got Oregon in there, and now you got Washington building its own LCFS program, of course. So, kind of what's next? What's kind of on your radar screen in terms of what's happening with the LCFS markets?
So one thing that I would just highlight out of California is inside of Newsom's executive order banning the sale of gasoline-powered vehicles by 2035. He also looked at extending the carbon intensity goals of the LCFS program. So one of the things that I would look for after the scoping plan is how does the ARB look past 2030? And also how do they incorporate the fact that, you know, as you reduce the number of gasoline powered vehicles in the state, you're going to see more and more of those vehicle fleet going to some sort of EV like car. And so you're just going to see a general switch of more EV generation coming into the program. I mean, I think, one, LCFS is not my expertise, but the thing that I do think is interesting is now that you've essentially gotten an LCFS program across the entire West Coast. And one of the, we talked about the CPP back in those days was you're going to have a mishmash, you're going to have like a patchwork of programs. That's exactly what we have right now with LCFS. You've got a patchwork of programs from, you know, BC all the way down to California. And so do you see any convergence of those markets over time? So, you know, one that could help a lot of the efficiencies. So far, we haven't seen that. And if you talk to market participants, they generally seem okay with, you know, price differences between Oregon and California. Washington, I think the real question is, you know, is there any teeth to that program?
Hey, Jim.
Yep.
Do you see the question that came in from Ken Nelson?
Oh, I'm sorry. Sorry, Ken. Does the SAF and biodiesel price chart versus cost include the value of the underlying fuel, or is that just the incentives? Jennifer, can you?
Yeah, sorry, I might have, I need to clarify a little bit here. So those prices are not traded prices. That's not a price assessment that's based on, you know, bid, ask, or herds trades. That is a cost-driven model with the main cost input is the feedstock that's driving the variation in that price. So our price assessment is a cost-based assessment. And then, so that if you create a gallon of SAF or a gallon of renewable diesel in this case, then you would have those incentives would be in that gallon. And then the question is, you know, if you're going to sell the fuel, those credits and those incentives would have to, you know, be shared between market participants. But the main thing to note is that it's a cost-based price assessment.
Great, thank you very much. So we have a couple of minutes left. Do we have a hard stop at 3, Lauren?
We can go a little over, but I you know me, I like to keep things on time.
Absolutely. So we'll jump into our lightning round, which seems just about right about now. So this will go very quickly. We only have a few questions, but Dan, I'll start with you. True or false? These are the best days yet for environmental markets.
No, or fuck no, one of the two.
Jennifer, true or false? More states will create market-based environmental markets over the next 12 months.
I mean, prove me wrong, but I'm going to have to go with false on that. No states that we don't already know about for 12 months.
Elana, yes, no, or maybe? The legitimacy of voluntary carbon offsets will continue to be a major focus in the months ahead.
Yes.
And Mike, true or false? Companies declaring net zero goals will increasingly use voluntary and compliance environmental markets to try to reach their goals.
I'm going to go with a possibly true, because I do know that some folks have been looking at offsets that actually cost more than California compliance offsets right now, and that could start with the rules there in California could start sucking some supply away from the state.
And finally, anyone who wants to chime in, yes or no, the COP26 this year, this fall will produce a framework for a global carbon market. Anyone?
Maybe.
Yeah.
Probably not. I mean, if you were in Madrid, it wasn't great.
Jennifer?
Yeah, I have no comment on that.
No. Mike, I'll finish with you. Any thought? Are we going to get a global carbon market?
We're not going to get a global carbon market anytime soon, but maybe they'll get a few more
No.
rules going. But big framework, I don't know. It's gonna be difficult.
We can always hope. This has been an awesome panel. I really thank everybody for joining in. I have a few very quick takeaways in my own kind of lightning round in my head thing. Mike, my takeaway from you is that we will wait and see what happens in Pennsylvania, and we will find out in just a few weeks kind of which way this thing is going to tilt. From Elana, I learned something new today. The Ocean-Based Climate Solutions Act is really something to keep an eye on. From Jennifer, the states that are bringing in RECs from other states is also is a trend worth watching, as well as kind of what the impact of offshore wind is going to have on REC markets going forward. Dan, my takeaway from you is that you don't believe in slides, but also that there will be an increase in corporates getting into these environmental markets. And we are going to continue to see significant interest from kind of the non-compliance groups in 20 and 21 going forward. So these markets are poised to grow much further in terms, not only in terms of the scope and the policies, but also in terms of who's participating in them. I think those are all really positive trends and developments for our markets. So I want to thank everybody here very much for your time, for your insights. It's been really great, and thank you for doing our first State of the Markets. Very much appreciated. I'll turn it back over to Lauren for wrap up, and thanks again for joining us.
Awesome. Round of applause to all of our panelists. Thank you for jumping in when you didn't have much instruction. So we really appreciate it. This is going to be part of a bigger series, State of the Markets. We might be doing more defined topics, but if you like this, if you have other ideas for webinars or events, please don't hesitate to reach out. We are always looking for input. If you want to speak, if you have a recommendation for a speaker, if you want to be a moderator like Jim, I think did a great job. If you are interested in joining EMA, you can go to enviromarkets.org. It's super easy to sign up now, and we have a brand new webinar coming to you on July 13th at 3 p.m. on the Maryland CAP. I think that was mentioned today. So thank you all so much for joining us. And until next time, be awesome and don't curse as much as Dan. All right, take care, everybody.